Good morning, one and all. Welcome to Developing Your Cash Flow Projection. This workshop is sponsored by the Maine Technology Institute and also by the Small Business Administration, who is a regular SCORE supporter, as we are considered part of them. So thank you all for joining us this morning, and we'll dive into the presentation. This is being recorded to the cloud, and will be a link to the recording, and the slide deck will be distributed to everybody via email, usually a day or two after the workshop has ended. If we could start off, perhaps, please, by introducing ourselves. It's helpful to me to have an idea of what business you're in and what stage you're in. So if you could please use the chat window to give a very brief description of what kind of business roughly you're in, whether you're still in the idea stage, whether you're in the process of starting or already in business. And if you have a primary concern or area of concern that you would like me to try to address, I'll be happy to try to do so. You can put that in the chat as well. I also invite you to ask questions as they arise, because if you have a question, almost certainly somebody else probably has the same question. And I invite you to do so by unmuting yourself and asking it verbally, or you can put it in the chat window. That's your choice. So whatever works for you is great, but from my perspective, it's wonderful to see faces out there. So I'm not just speaking to the void. Anyhow, I see we've got somebody in hospitality, real estate, long-term rental, short-term rental, photography and styling services. Wonderful.
Ty showed me a cool trick. So,
yes.
all right, trying to figure out like my cash flow and some AI and some other things I want to do. But so when they have a webinar going on, you can record it, and that way I can always come back and look at it. So right now, so when you
anyhow, continuing along. Let's start by talking about why cash flow is important. A positive cash flow allows your company, first of all, to survive. If you have a negative cash flow, eventually your company runs out of cash and will have to close. Secondly, having a sufficiently large positive cash flow allows you as the owner to compensate yourself for the time and money that you put into your business. Thirdly, if a company wishes to grow, it almost always requires cash to help fund that growth for a variety of reasons. Fourthly, if you are going to be seeking loans, or if you have loans to repay, you need to be generating cash. Banks will usually look at your cash flow in deciding how much of a loan they are willing to make to you. And if you're repaying your loan, you need to have enough cash being generated to make the monthly payments. And I would just add as an aside that the best time to apply for a loan is before you actually need it. That demonstrates to the lender that you're doing your financial planning and can see far enough ahead to foresee the need for a loan. And the best way of looking that far ahead is often by doing a cash flow projection. Cash flow is something that you've probably heard bandied about as a term, but many people are a little fuzzy on exactly what constitutes cash flow. So cash flow is different from your profits. It's close, but different. Usually, cash flow is calculated by starting with your net profit, your bottom line, and then adding back depreciation. because depreciation is a non-cash expense. It reduces your profit, which is good because it reduces your taxes. But since the asset that's being depreciated was paid for often years previously, you didn't actually spend that money this year. So your depreciation amount does not reduce your cash balance in your bank account. So cash flow usually starts by taking profit and adding back depreciation. However, there are a number of other accounts which typically cause potentially large changes to a company's cash position. The first for most companies is inventory. If your inventories rise significantly from last year to this year, say, that means you've invested a fair bit of your cash in that inventory. Now, maybe that's financed by your vendors, in which case that's great and doesn't take as much cash, but eventually you have to pay those vendors. So typically, if your inventory rises, your cash will go down. And if your inventory falls, your cash will go up. So if you anticipate changes in inventory level, you should reflect that in your cash flow projection. Secondly, changes in accounts receivable or accounts payable also change your cash position. If your customers owed you $100,000 at the end of last year, and now they only owe you $50,000, then your cash balance has gone up by $50,000. Similarly, if accounts receivable went up, then your cash balance went down, because even though you've made the sale, you have not received the money for it yet. And that sale is reflected in your profits, but you don't have the cash for it yet. So it's hurt your cash balance. Accounts payable work very much the same way, just inverse. If accounts payable go up, that means you owe your vendors more, which means they've shipped you something, but you haven't paid for it yet, which means you probably considered it an expense on your income statement. But because you haven't paid for it, the cash hasn't left your account yet. So that increases your cash when accounts payable go up. And when accounts payable go down, that means you're paying what you owe, and therefore cash goes down. Any capital expenses you make will reduce your cash. So if you buy a new truck and you did not finance the purchase, then obviously you had to spend your cash to buy the truck. But because the truck is a long-lived asset, which will be depreciated a little bit each year over its expected life, you don't expense the truck when you purchase it. Instead, the expense of buying it is spread over its lifetime in the form of depreciation to better match your expenses for the truck with the revenue that it's going to help you generate. So that means that your purchase of the truck reduces your cash, but is not an expense in this year. The only thing that will be expensed is part of the cost of the truck in the form of depreciation. So buying a truck will reduce your cash by the full amount you paid, but will not reduce your profit by the same amount. It'll reduce your profit by less. So you need to take capital expenses into account. So if you're replacing machinery, making major repairs to your building, all that sort of thing, that may not be an expense you see on your income statement, depending on exactly how you're expensing things and what your accountant has you doing for tax purposes. And it may be an expense you nevertheless need to plan for in your cash flow projection, because it will reduce your cash balance. And then a frequent sneaky confusion about cash flow is debt payments. Every time you make a debt payment, typically, not always, but typically the payment has two parts to it. Part of it is an interest payment, and the other part of it is a principal payment. The interest payment is an expense on your income statement, but the principal payment is not. You're just returning money that you received previously. When you received a loan, that loan amount was not considered income. And so now when you repay the loan principal amount, that is not considered an expense. Therefore, you need to take your profit before depreciation and subtract all of your principal payments made during the year in order to get at a more accurate estimate of your cash flow. So all of those are important to consider. In truth, just about any balance sheet account can have an impact on your cash flow. And therefore, you need to consider all of your balance sheet accounts. If you use accounting software, you will find that your accounting software does offer you a statement of cash flows, which does the complete analysis for you, which is very handy. I will tell you, it can also get confusing at times, but that does tell you exactly how your cash changed and why. So when you're forecasting your cash flow, you can take all of that into account, but that's often more trouble than it's worth. And these accounts that I've listed on this slide are the ones that are most likely to affect your cash flow. So if you don't expect a change in inventory levels and don't expect accounts receivable or accounts payable to change, then you don't need to worry about those. But do think about any upcoming capital expenses and any debt repayment that you'll have during the period that you're forecasting. So before we get into the actual forecasting process, let me try to reassure you, because this is something that many people are concerned about. Many people seem to feel that a forecast has to be right. And the reality of it is that nobody can make a forecast that is going to be 100% correct. So don't worry about being 100% correct. Your forecast is going to be wrong. Hopefully not very wrong. And you won't know whether it's going to be too high or too low. So do the best job you can, but don't worry about having it be right. Nobody's expecting it to be totally correct. What people do expect is that you will make reasonable assumptions, that you will document your assumptions. So if they ask you about something about your forecast, you can figure out, what growth rate did I assume there? Or why did I have that number go up by that much? So put your assumptions into your forecast off on the side somewhere or down below, your choice. And if you're relying on some things like estimates of how quickly your market is growing, it's often very helpful to be able to cite third-party data to say, oh, well, I read this article, or I saw this study, or my industry trade group did this research and came up with this as the estimated growth rate for next year. So do try to cite third-party data when you can. It's always a good idea to go looking for some, even if it may not be easy to find, just to double check your own gut feel for your business. And don't neglect to use resources like your local public library, which often can have access to online databases, which may have information about your industry that you could use in your marketing and forecasting process. So, how to start your forecast? I recommend that you start your forecast with your revenues. And the reason for this is it's miraculous how, if somebody forecasts their expected expenses first, then their revenue forecast miraculously ends up slightly higher than their expenses. On the other hand, if you start by forecasting your revenues and then forecast your expenses, if it turns out your expenses are too high relative to your revenues, you'll see a loss, and that serves as a wake-up call that you may have some problems ahead. Everybody goes back and revises their forecasts. They tweak them, they play with them to say, well, what if things are better than I expect? What if things are worse than I expect? But if in your first attempt at a forecast, you do revenues first and then expenses, that is more likely to get you an honest revenue number. Now, in what I'm about to present, I want to acknowledge that much can depend on your business. Differing businesses will require very different revenue forecasting approaches. And therefore, forecasting can be much easier for some businesses than for others. So with that in mind, I often recommend that you do your revenue forecast in a completely separate worksheet, one which is really tailored to the way that you find most helpful to forecast your revenues for your business. And then take your total revenue numbers at the bottom and cut and paste them into the worksheet I'm going to show you. There's no need in many cases to bore your loan officer with all the gory details of your revenue forecast. They may wish to see the revenue forecast worksheet, but they're probably not going to spend a ton of time looking at it. In the end, they're more interested in the total dollar forecast for your revenues, and is that reasonable? And then same idea for your expenses. Anyhow, back to revenue forecasts. There are two primary approaches to forecasting your revenues, top down and bottom up. Top down starts with the size of the market you serve, and then you estimate what share of that market you expect to gain, and that yields a dollar number that should reflect your revenues. This is a fairly quick and easy process to do if you know these numbers. So it can be very difficult sometimes to come up with a market size. For example, if I serve a market that is very local, then there's a good chance that there isn't really much third-party market size research on my local market. Maybe there is, maybe there isn't. But I could potentially get a market size nationally and then get an estimate for what the market size was locally last year. If I compare last year's local revenues in my market to a national market last year, I can get a rough percentage that my locality is of the national market, apply that percentage to a national forecast for next year, and that could be a way of estimating the market size locally for next year. The problem is the local market doesn't necessarily grow at the same rate the national market does. You may have heard the expression at times that if the national economy gets a cold, the New England economy gets the flu. Well, there are things like that, which can mean that an estimate for a local market needs to be different from the estimated growth for a national market. And that adds to the complexity of doing a top-down forecast. But even if this is wrong, it's important to nevertheless consider the top-down approach, because if you say, okay, I think I'm going to have a 10% share of my local market, and this is what the local market seems to be, that serves as a good double check on the numbers you generate from the bottom-up approach, which I'll talk about next. So I encourage you to work on a top-down forecast. I'm not going to go through it in detail any further today, because there isn't really much more than what I just described. What's the size? What's your share? There could be a couple of steps beyond that to break it down a little further, but that's really all there is to it conceptually. In practice, it takes a little more work. Turning to the bottom-up approach, a bottom-up revenue estimate starts by analyzing your capacity as a business. What limits your ability to generate revenues? Is it the real estate you have? Is it the number of trucks you have, the number of employees you have, the number of cash registers you have? Is it something about your manufacturing process? There are any number of things that could be the limiting factor in how much revenue you can generate. In many small businesses, it's the owner's time. You only have so many hours per week, in which case that's that. But think carefully about what it is that limits your revenues as a business in any calendar year or month for that matter. And then based on that, decide how much revenue you could generate if you were firing on all cylinders. If you're working at capacity all day, every day that you work, how much revenue would you generate? Chances are you don't generate that much revenue because you can't spend all of your time every day generating revenue. You have to spend some time keeping your books. You have to spend some time doing your marketing. You have to spend some time doing sales, and so on and so forth. So once you come up with a total capacity number, then try to come up with an estimate for what percentage of that capacity are you actually using. If you've been in business for a while, that's easier because you can look back at last year's numbers and say, well, this was the actual revenue I got, and what percentage is that of the capacity number I just came up with? Okay, looks like I was operating at about 60% of capacity. So for next year, unless you plan to make any changes in the way you operate, maybe you'll continue operating at 60% of capacity. Are you going to do something to increase your capacity or shrink your capacity for next year? For example, maybe you decided you don't need this much retail space and you're going to downsize to a smaller store. So you expect your capacity to go down, but maybe your utilization will go up. That's fine. Then estimate your revenue from an average sale. Now, your capacity might be in hours, staff hours available. Your capacity might be in machine hours available. There are any numbers of ways you could measure it. It might be in cash register transactions per hour. It might be in number of table turns if you're a restaurant. If you're in real estate, it might be the number of clients per month you tend to get versus the number of clients you have the capacity to serve. Anyhow, then estimate the average revenue you get per unit of capacity that you estimated. If it's real estate, what's your average commission? If it's a restaurant, what's the average bill for a table? If it's a retail business, what's the average sale at the cash register? Anyhow, that's the idea. If you then take your capacity times the percent utilized times the average dollar sale per unit of capacity, there you have a bottom-up revenue projection. So this is basically the process I described. You can think of your capacity being like the different sized pipes at the right. The larger your capacity, the more that can flow through them. Think carefully about what limits your capacity and use that in your analysis. I encourage you, if you're taking notes at the moment, to jot down any thoughts you have, because you might find that ideas that come to you as I talk about them might escape you half an hour from now if you try to think back about them. So jot some notes down on what you feel limits your capacity and why. And that then leads to thoughts about, well, do I want to change that? Maybe not now, but next year, the year after, and how would I change it? In more complex businesses, you may address one constraint, but there are other constraints that you'd also need to address in order to truly increase your capacity. That's pretty normal. So When you look at the percentage of your capacity you're using, you may find that it varies wildly during the course of 1 year. This is very typical, for example, of seasonal businesses. So that's fine. Uh, don't don't worry about that. That's perfectly normal. But look at it over the course of the year and come up with an average capacity utilization if you wish. Or alternatively, you could keep it seasonal. If you're doing a monthly cash flow forecast, then have part of your forecast be seasonal capacity utilization forecast. Customer buying patterns change, sometimes during the year, sometimes from year to year. That could affect your capacity utilization. You may also have maintenance or administrative needs. Oh, we're going to shut the plant down for a month to make a major upgrade. So your capacity utilization will be 0 during that month. It's important to plan for that as part of your cash flow projection. And do make note in your assumptions section about why you expect your capacity utilization to be varying. When you think about a unit of capacity, whether it's machine hours or cash registers or tables or clients that come through the door, your average revenue per client could also vary seasonally, or it may vary by type of client, large, small, that sort of thing. So you may wish to break your capacity down in some way. And this can also be useful for marketing reasons to say, for example, if you're in real estate, oh, I have people that want inexpensive properties and people that want prices no object properties. And maybe you want to always keep some of your time free in case a prices no object client walks through the door. Maybe you want to keep a certain table free because you don't want just 1 or 2 people sitting there. You'd rather save it for parties of 6 or more. Even if it's empty, filling it once a week will make up for leaving it empty the rest of the week, maybe. So there are lots of reasons that your revenue unit per capacity might also vary a bit from time to time. If you just want to use an average, fine. That's great for a quick estimate. If you want to get more precise or you want to play around different scenarios, then maybe you want to allow that to vary over time. So here's an example of a bottom-up revenue estimate. Suppose I'm a math tutor, which I have been for 26 years. I might look at the time that I'm willing to spend meeting with students and decide that I have 18 time slots available per week. Kids don't get out of school until a certain hour. I need some time to eat dinner. Their parents are only willing to have them meet with a tutor so late in the evening. There's some time slots on weekends, perhaps, but I want to have a weekend too, so I'm not going to make too many time slots available on weekends. Anyhow, somehow I came up with 18 time slots available per week. I look back at my calendar and realize that they're only 90% booked on average. And maybe I charge $50 an hour. So 18 time slots times 90% times $50 an hour is $810 per week times 4.35 weeks per month, 52 weeks per year divided by 12 months. Says I could be earning $3,523 every month. Oh, except for the summer, because in the summer, demand for tutoring goes way down. So maybe I meet with 4 students per week in the summer at the same rate. And so that comes out to $868 per month in the summer. So that would be the basis for a bottom-up revenue projection for a tutoring business. Any questions so far on this idea of top-down and bottom-up revenue projections? I need to change this slide, obviously, because we don't have breakout rooms in this, but never mind. Not hearing any questions. I'm not seeing questions in the chat window. So I'll forge on. So this is an example of a cash flow projection spreadsheet. You don't have to use this format. This is one that we make available on our website. I like it because 1 year fits on one page. And so it's sort of easy to get a sense of the whole pretty quickly. There are additional worksheets in this. There's a second page below, which lets you enter loans if you foresee taking out some loans, and it'll calculate what the monthly payment is for you and automatically fill that in this spreadsheet. But everything that has a green background is a cell you can change. And so, for example, if you look up here at the top left, you're welcome to change the starting date for your cash flow projection, and all the subsequent dates are formulas and will automatically change. You enter your beginning cash balance, your bank balance, basically. You can change the names of anything in column B here. If you'd rather call something different than what's called here, cool, go for it. A whole bunch of possible expenses are laid out. Once again, if you don't have those, then delete it or change it as you wish. That's your call. I want to point out the major sections. At the top, you have cash receipts from operating your business, and then cash receipts that are capital inflows that, for example, might come from loans you receive or from new investments of cash that you or partners or investors might make in your business. Then you get the cash paid out for operating reasons, your typical expenses you see on your income statement. At the bottom here, you see a line for loan interest paid. That would come automatically from any loans you put on the spreadsheet below. And then lastly, cash paid out for capital items, including loan principal from the loan sheet below, but equipment purchases, building repairs, withdrawals you make as the owner to pay estimated taxes, assuming you're an LLC or a partnership, and any other owner draws you take to pay yourself if you're not paying yourself as payroll. And after all of that, you end up with this blue line at the bottom, which is the total cash that's come in minus all the cash that you paid out. And then you subtract that from your beginning cash. And that provides you your ending cash balance. So when you look at a cash flow projection, the first thing that's really interesting is to look at the blue line and make sure that your ending cash stays at a comfortable balance for the next year or 2 or 3 if you're going to do the next 2 years as well. There are additional worksheets to do the next year and the following year. So your goal is to stay at a comfortable bank balance. And I use the word comfortable intentionally because your comfort level for your business might be different than my comfort level for my business. And so think about what cash balance will let you sleep well at night, in effect. If you are not worried that your business is going to run out of cash next month, then that's good. And that's the goal of a cash flow forecast, to help you sleep well at night. So as I just said, you're welcome to modify the contents of any of the green cells I just showed you. And cells that have white or blue backgrounds are formulas. You can change those too, but you better be comfortable with what you're doing and comfortable with spreadsheet formulas if you do so. So I said a link in the chat window, which I haven't quite put there yet, but I will post a link in the chat window for this spreadsheet from the SCORE website. And you can use that to download this and use it for yourself. Let me just get to that spot. Where am I here? It's not, there we are. Sorry for the delay here. Okay. I wait for my resource to come up. There we go. And So here is there we go. So I will now go to the chat window and share a link to our website for this spreadsheet, and you can download it from there and begin working on it whenever it's comfortable for you. Any questions about the template so far? It's just a template, and so you're welcome to tweak it. And there are many other cash flow templates out there in the world. This is just one that I use fairly frequently here in SCORE. So think about your other sources of cash as well. So the template doesn't spend a lot of time going into this, but I talked about them earlier. And so if, for example, you expect your revenues to be growing in part because you are going to start offering terms to your customers, you're going to let them pay in 2 weeks or in a month or something like that. The minute you start doing that, even though you've made the sale in a month, you're not going to see the cash for all of your sales in that month. Some of your customers are going to take full advantage of the terms you offer them and pay you later. And so if you offer payment 30 days, maybe then that means that you want to put your cash from your sales as happening a month after you expect the sales. So if you have seasonal sales, all of your cash inflows would be offset by a month from those seasonal sales. If you expect investments, you want to make sure those go in. If you expect to receive loans or pay off loans, you want to make sure those are included in your cash flow forecast. If you expect to receive grants or participate in competitions, well, are you going to get it or not? Who knows? But you might put that in if you think you're going to get it, just to remind yourself that you're hoping to get it at that point. And if you want to use crowdfunding, well, how much revenue will it really generate and over what period of time? How many followers do you have already that you can count on participating? You might want to spread any crowdfunding revenue over time in the same sort of way. I see Lincoln's asked, so what should the plan be for managing lower cash flow periods? If you have a period where you expect cash flows to be low, and therefore you see your ending bank balance dropping every month, if your bank balance gets so low that you're not going to sleep well at night, then many companies will obtain a line of credit from a bank, which is essentially a pre-approved short-term loan. It might cost you a couple $100 to apply, depending on the size of the loan you're asking for. You don't pay any interest until you actually have taken that loan. You can repay it. Typically, it has to be repaid within 12 months. And you don't pay any interest if the outstanding balance is zero. You only pay interest when you have an outstanding balance. So people who use lines of credit will typically maybe draw down for a couple of months during the slow period. And then the minute business starts coming back up, they repay it as quickly as they can in order to reduce their out-of-pocket interest costs. Or you could get an additional investor infusion of cash. So if you're the owner, you as the owner might put more of your cash into the business to sustain it through the slow period. Or that might come from other investors. There's another source of cash, which is to ask your vendors for terms. So when you go to repurchase inventory, you say, hey, I've been a good customer of yours for 2 years. Would you be willing to let me pay in 2 weeks or 4 weeks or something like that? They might do that instead of giving you a discount, or maybe in addition to giving you a discount. But in larger businesses and inventory dependent businesses, you may find that you can finance some of your needs by getting terms from your vendors. I see Chauncey asks, do you create a line or another account to move money into for capital expenses. I'm assuming you're talking about on the cash flow spreadsheet here. There is a line on the cash flow spreadsheet for capital expenses already. So if I go back here quickly, there we go. Down here, line 32, equipment purchases, and line 33, major building repairs. Those are both capital expenses. So you could just change the labeling on those lines to call it capital expenses if that makes you happy. Hopefully that addresses your question. So once again, any of the labels next to the expenses, they're all in green, so you can change them to be the words that you use to describe your expenses or the kinds of expenses that are more relevant to your business. Totally your choice. You don't have to use any of those labels. Many are account names that frequently occur in your financial statements, and it's often helpful to use the same label as appears in your financial statements. But for forecasting purposes, you may wish to glom together a series of accounts from your financial statements if they don't add up to a big number. So focus your cash flow forecast on the bigger numbers, and for that purpose, it may be helpful to put smaller accounts together. So do you need to have one account for paper clips and another for erasers and another for pencils? No, you can probably call them all supplies. It makes forecasting a lot easier. Note that as you forecast your expenses, some expenses may occur only once. Those are typically called startup expenses, but they may not be just startup. They may be once a year kind of things. Maybe some insurance premiums only get paid once a year. That's okay. But look for the ones that happen only once a year and make sure they're included. So it's very helpful if you've been in business to look back over your income statement by month for the past year as you start forecasting ahead. That will help you avoid missing something. Some expenses may vary with your revenues. Those will typically be your cost of goods sold, but note that things like if you pay a sales commissions are not considered cost of goods sold. They are just administrative expenses. And since they will vary with your revenues, you should make sure that you are tracking them to stay the percentage of revenues that you expect them to be. Expenses could vary with temperature. For example, your utility costs are probably higher in the winter in Maine than they are in the summer. If you're down south, they might be higher in the summer than they are in the winter. Some expenses may be constant, your rent, your insurance payments. Some insurance companies bill twice a year instead of monthly or once a year. So once again, you want to have payments reflected when they occur, not just spread evenly across all 12 months if you don't have to pay them evenly over 12 months. And lastly, once you've come up with your list of expenses, it's often helpful if you can come up with industry ratios for your industry to compare the types of expenses you have to your common industry ratio. If you don't know where to dig up these industry ratios, talk to a business reference librarian at your local public library, or perhaps your local chamber of commerce, or your bank lending officer may have access to industry ratios for your industry and would be happy to provide them to you. And so they're typically things like, well, payroll is 40% of expenses or revenues, or in other industries, payroll may be 80% of revenues. But so compare your expense levels to your industry ratios to make sure they're not out of line. And just to emphasize, when you're doing a cash flow forecast, you want to enter each of your expenses when you expect to pay it. It's when the cash leaves your bank account that is relevant to a cash flow forecast. If you use cash accounting for your accounting system, then that'll be the same as what your accounting system shows. But if you use accrual accounting for your accounting system, the one you pay could be very different than when you recognize the expense. Leslie says, I can't figure out how to copy the spreadsheet. The link I sent was to the page on our website, which has a big blue download button. And if you click that download button, it will download an Excel spreadsheet to your computer. And that would be the best way to obtain a copy of the spreadsheet on your computer. If that is giving you trouble, stick around afterwards and I'll be happy to try to help you troubleshoot. Okay, so coming up with expenses. If you are already operating, obviously use your expense history, your income statement by month for the past 12 months to get a sense of, are your expenses steady? Do they vary season to season? What are your major expenses? What are your small expenses? Make sure your total expenses are roughly in line with the total you're forecasting. And given that we're living in inflationary times, you probably expect your forecast expenses to be a bit higher than your historical ones. On the other hand, if you're starting a new business, you don't have any history that you can rely on. And your only option is really to make your best estimate you can. But if you base that estimate on, say, quotes you receive from suppliers or your insurance agent, or perhaps the same industry ratios I talked about a minute ago that are typical expense ratios for your industry, or perhaps your landlord could estimate what your rent and your utilities will be for a space you're considering leasing. If you ask around, I think you'll find that you can find at least some support for estimates for a number of the numbers that you need to put into your forecast. You might be able to make up numbers. I wouldn't advise it. If you have a good experience with this sort of thing, cool. But if this is all new to you, then do talk to other people who are familiar with your kind of business. And you may find that other people are perfectly happy to talk to you. For example, if you're traveling down to Boston somewhere and you walk into a shop that is your kind of business in Boston, and you're no threat to them because you don't intend to expand into their area, ask if you can talk to the owner and say, hey, I'm going to start a similar business in my town. I'm not going to be competing with you. I'm trying to come up with a cash flow forecast. Might you be able to give me a rough sense of what percentage of your expenses are electricity versus payroll or things like that? And if you can find a buddy in your business in another town, on social media, what the heck? That can be really helpful to people in just about any business. And if you're including staff costs, which if you have employees, you should obviously, don't overlook payroll taxes, unemployment insurance, and any workers' compensation insurance payments that your business is going to be liable for. Just looking at the salaries you pay is not enough. You need to consider these other costs as well. So Chauncey asks, so if I am setting $500 away per month for a capital expense that is incurred once every 10 years, is the cash flow projection reduced by 500 even though the cash is just set aside? Well, it's a good question. Maybe. If you are truly setting aside by moving it into a separate bank account that you do not touch until you make that capital expense, then yeah, you could consider that an expense. But if your business was in deep weeds and it was a question of survival, would you tap that account to keep the business going, or would you shut the business? If you're going to tap that account to keep the business going, then the cash really is actually still available, even though you've put it in a separate envelope for your future purchase. So personally, I would probably not consider that set aside as a use of cash. I would continue doing that set aside, and I might put it in a separate bank account or envelope or whatever. But if I know that I could tap that money if my business was in trouble, then it's contributing to that minimum balance that lets me sleep well at night. And therefore, I want to see that in my bottom line of the cash available to my business. That's just me. You don't have to do it that way, but that would be how I'd be inclined to do it. Somebody else, let's see here. Susan says, our wholesaler gives us major discounts at the end of their year. We end up buying inventory and preparing to sell it next year. Do you have an idea or strategy on how to deal with costs of goods for tax purposes? So the quick answer there is, if you use accrual accounting for your tax return, then you will not recognize inventory costs as an expense when you purchase the inventory. That will be a capitalized item. You know, if you buy $1,000 worth of inventory, your inventory account goes up by $1,000 and none of your expenses change. However, when you sell that inventory, I sell a $100 item, my revenues go up by $150 or whatever the price of it was. And my cost of goods sold goes up by maybe $120, which is the cost of purchasing it, that $100, plus the cost of storing it, the cost of keeping the inventory between when you received it and when you actually sold it to your customer. So the costs of maintaining inventory, the shelving you're depreciating, the employees you pay to stock and unstock inventory, and so on, are all considered part of cost of goods sold and are all capitalizable, meaning you don't have to recognize them as expenses if you're using accrual accounting. If you're using cash accounting, it's simpler, but when you write the check is when you take the expense. So that is for tax purposes. For cash flow forecasting reasons, when you buy the inventory, that's when the cash leaves your account, and that's when you got to put it in your cash flow forecast. So you would see a big hit to your cash at the end of the year as you stock up for the following year. And you want to see that because you will be low on cash because you did pay for that new inventory for the next year. So it's a little confusing in that case because what you're reporting in your financial statements using accrual accounting will look very different than what you're seeing in your cash flow forecast. And that's the reason for doing a cash flow forecast, to see whether you're putting your business at risk by buying too much inventory too early in the year. Coming back to an earlier theme, you could ask that vendor to give you terms. I'm going to buy a huge chunk thanks to your sale. Would you also give me terms so I don't have to pay for it for 45 days so I can finish my busy season and get that cash in to pay you? See what they say. It doesn't hurt to ask. So for each line of expenses in your cash flow forecast, ask yourself, should it be flat or should it vary month to month? And if so, why? Will the expenses grow before revenues grow, such as stocking up on inventory? Or will the expenses grow with revenues? Do you wish to lump this expense together with others to make forecasting, et cetera, easier? Once again, you're welcome to change the labels on the expenses and try doing a Google search for common expense areas in your industry and see if Google will tell you an estimated percentage of total that you could use if you're new to your business. However, look at your bottom line, and your total expenses have to be close to reality. Now, the good news is most people's expense forecasts have errors, but those errors tend to offset one another to some extent. And so most people who do a reasonably good job of trying to be reasonable in their expense forecasts will tend to be within about 10% of reality. And that's cool. Any other questions about expense forecasts? The last section on the sheet is for capital expenses and repayments of debt, but think about anticipated future uses of cash. Are you buying new equipment at some point down the line? Are you going to be repaying loans, particularly loans that have balloon payments at the end, where you have a big principal repayment at the end of the loan? Or are you going to be refinancing that? If you expect to have to withdraw amounts yourself as the owner to pay estimated taxes, that should be on there, or to pay your home mortgage, whatever. So do look ahead to cash needs that you as the owner have or that the business will have that will affect the business's cash flow, and include those in your cash flow forecast. So we've gotten through the 4 sections of your cash flow forecast. You can now look at the blue line at the bottom. That shows your cash balance month to month to month. And if it's negative, you have a problem. That means you're negative, you're overdrawn at the bank. If it's very close to being zero, but negative, that's probably something you could finagle. It's not the end of the world. You could pay a couple of vendors late, or maybe postpone a purchase by a month. And you could address a negative cash balance that way. But if it's seriously negative, then you may need outside funding to get you through that period, or you may need to change your business strategy in some way. If a month is close to zero, but not quite negative, if the balance in your bank account is projected to be lower than lets you sleep well at night, then you have a concern, not a problem. What could you do to perhaps keep it further away from zero, keep it a little more positive? And this is the same things I just mentioned. If it's slightly negative, you could postpone some expenses. You could pay some vendors a little late. Many vendors won't come down your hard if you're a few days or a few weeks late. Just don't make a habit of it. You want them to perceive you as a good customer. So the big question becomes, how close a number to zero do you feel is safe for your business? And for one person, it might be $500. And for somebody else, it might be 500,000. It depends on the size of the business. It depends on the amount of other cash you have personally that you're prepared to put into the business if need be. So it really does vary greatly from one person to another. So ways you can improve your bottom line, your cash balance. As I said, ask customers for a deposit before you send them what they've ordered. That doesn't work for all industries, but for example, if you're a consultant, you can certainly ask for a deposit, and then that reduces a later bill. Lawyers call that a retainer. But if you are a custom manufacturer, every custom manufacturer I know of always asks for a deposit. That deposit often corresponds to their materials costs. And so that's a good rule of thumb to keep in mind. You don't have to do that, but if you're going to have to buy stuff to do work, you might want to ask the customer for a deposit that will cover the cost of buying the materials. You can be paid for your labor later. Secondly, to control the bottom line, control your expenses carefully, particularly fixed expenses and inventory. Anything you use to buy inventory is going to sit on the shelf until it sells. Everybody's torn between having it on the shelf and available when a customer wants it versus having it sit on the shelf and therefore the money's not in my bank account anymore. But also pay attention to fixed expenses. As an example, a new business might be considering leasing a storefront. Do you want to sign a 2-year lease for a lower rate per month? Or would you rather sign a 2-month lease with an option to sign a 2-year lease at the end of 2 months? You pay a lot more per month for the next couple of months, but that's cheaper than being stuck with a 2-year lease. So look at the expenses that are fixed for you, that do not vary with revenues, and try to control those carefully from day one. So if you can rent instead of purchasing, it hurts your profits by a bit, but it helps your cash a lot. If you buy smaller quantities of things, even though it's at a higher cost per unit, that saves you cash now. Yeah, it hurts your profits a bit, but it keeps cash in your bank account. So there are ways like that you can use to reduce your immediate near-term cash expenses and help improve your bottom line for cash in the months to come. And if your vendors offer you terms, use them. Pay them on time, but 30 days from now means you have that cash for 30 more days than you otherwise would have, and therefore your bank balance is better for the next 30 days than it otherwise would have been. I cannot emphasize enough that your business cannot run out of cash. If the cash need is seasonal, as I said earlier, consider a line of credit. If the cash need is to fund growth, you can ask your bank for a loan to help fund your growth, particularly if you have been operating for several years. They will look at your operating history and be a lot more comfortable with your cash flow when you have an operating history to base it on. And if you're trying to get your business to break even, it's still losing cash every month. You might qualify for a grant. Not many businesses do, but particularly if you're in a tech business in Maine, MTI could be a source of a grant to help you. Your town might offer some grants if you employ people in town, particularly if it's a city. And if you wish to offer some of your personal assets as collateral for a bank loan, banks are willing to lend to new businesses if the owner is willing to guarantee the loan personally. So a home equity loan, in effect, you're going to mortgage your house to guarantee the loan to your business. If you're willing to do that, great. If you're not willing to do that, then don't. That's your call. So we're pretty much through everything, a few minutes late. Any further questions people have? Well, I'm not seeing any. I'm happy to stick around for a few minutes and answer things by voice if you wish. I see one more. And SCORE is an all-volunteer organization founded in 1964. We offer free mentoring and many workshops such as this. Check out our workshop schedule on our website, score.org. We've worked with over 11 million entrepreneurs in the United States over our lifetime. We are a nonprofit. We're a partner of the Small Business Administration, and we have over 300 offices throughout the United States. So if you wish to sign up for a SCORE mentor, you can go to score.org and do so, or I was going to say you can click on the QR code on the next slide, but it's not there. So go to score.org and sign up for mentor. It'll ask for your zip code and try to assign you a local mentor that way. We treat all your information as confidential, and we're happy to connect you with other mentors in our organization and meet collectively if there are people that have experience that we might not have that is relevant to the questions you're asking. So thank you all very much for coming today, and I hope you enjoy the rest of the day. Any last minute questions?
Thank you.
You're most welcome.